Time to pull the curtain back and break down what really just happened. The Trump-China trade talks are officially over, and while both sides are pretending things are calm, that calm won't last long. This isn't peace. It's a pause before the next big storm. Both Washington and Beijing made concessions, but they're coming from very different positions. China has managed to expose deep weaknesses in the U.S. economy, especially America's dependency on Chinese rare earth materials, while Trump's team has quietly backed off from aggressive tariff threats that could have done serious long-term damage. The only visible win the U.S. can really claim right now? Soybeans. Scott Bessent, the man representing America's farmers, is celebrating, calling it a massive breakthrough. China has agreed to buy 12 million tons of soybeans this year, and for the next 3 years, they'll supposedly purchase at least 25 million tons annually. Sounds like a big comeback, right? Almost like a reboot of the Phase 1 trade deal from the last tariff war. But there's a catch, a big one. China made those same promises before and they didn't keep them. And this time, Beijing's watching closely to see if Trump actually keeps his word before they follow through. So while the headlines sound positive, nothing here is guaranteed. Even so, jumping from near zero to 12 million tons is a massive move. That's way above the average of the past few years. From now until mid-2026, China's supposed to scale its soybean buying dramatically. But remember, there's still a 10% tariff on all U.S. goods entering China. That means either Beijing is subsidizing its own importers or Chinese buyers are simply eating the extra cost. Neither of those point to a permanent deal. It's a temporary truce, not a lasting fix. And it'll likely fade once Trump leaves office. Because the truth is simple. China will always go for the cheaper deal. And Brazil? Brazil can deliver soybeans cheaper and faster than almost anyone. Brazilian farmers are a global powerhouse. They can expand production quickly and flood the market with supply. If that happens, U.S. farmers will face falling prices and shrinking profits. But maybe the real issue isn't even China or Brazil. It's America's own farm economy. U.S. farming has become brutally expensive. Since 2020, production costs have exploded by more than 30%. Why? Because the Federal Reserve printed trillions of dollars, driving up the price of everything, from fertilizer and feed to machinery and fuel. Add Trump's tariffs on top, and the cost of farming equipment and chemicals climbs even higher. The math simply doesn't work anymore. To survive, U.S. farmers would have to slash expenses to the bone or pull off a miracle in productivity. But you can't just wish that into existence. Even if you automate labor and replace workers with machines, you still face steep interest payments, expensive supplies, and rising fuel costs. And unless the trade war ends, American-made farm equipment will stay expensive too. If Trump really wants to make America great again, he might want to start with something simpler. Make America affordable again. Because even with China buying 25 million tons of soybeans a year, that can't save a system this broken. U.S. soybean farmers are losing over $100 per acre. The more they plant, the more they lose. It's a losing game that no amount of foreign demand can fix. So yes, China's New Deal will move some of those soybeans sitting in storage. But it's just a band-aid. The industry still depends heavily on government subsidies to survive. What Scott Bessent is calling a victory is really just a short-term patch on a long-term wound. And there's another uncomfortable truth. The U.S. is losing its cost advantage. Brazil's production is at least 10% cheaper than America's, and that margin matters in global trade. Soybeans are a commodity. Prices are razor thin, and every penny counts. China knows this. That's why it's diversifying its suppliers and deepening ties with its BRICS partners instead of locking itself back into U.S. contracts. Trading with Brazil also comes with another big advantage. They don't have to use U.S. dollars. Payments can happen in local currencies, something China increasingly prefers as it pushes to move away from dollar dependency. Buying soy from America means paying in dollars, something Beijing would rather avoid. And that raises the next big question. What exactly did the U.S. give up to get this short-term win? Well, two major things stand out, and one of them we've already predicted. Trump simply can't enforce Russian oil sanctions on China. To do that, he'd have to punish the world's biggest buyer of Russian crude, Beijing itself. And that's not a fight Washington is ready for. Let's be real. Trying to cut off Russia's oil sounds good on paper, but in practice, that move would wreck global trade overnight. That's why Putin's revenue stream isn't drying up anytime soon. With crude prices staying high, Moscow could actually earn more, not less. And don't forget, shipping fees are cheaper now, which makes exports even more profitable. But energy isn't even the biggest problem anymore. The real flashpoint is rare earth metals, the lifeblood of modern technology. And here's the catch. Trump can't afford to let America's booming AI sector run out of them. Those endless data centers powering machine learning, they all rely on Chinese rare earths. Without that supply, the so-called AI revolution comes to a grinding halt. So Washington made a massive concession. Both the US and China are now stockpiling critical materials like it's wartime. But there's a twist. The US quietly delayed its 50% ownership rule, the regulation that stopped American companies from dealing with Chinese firms tied to blacklisted corporations. That rule is now on pause. For the next 12 months, Trump is lifting sanctions on certain Chinese subsidiaries, even if they're owned by banned companies like Huawei or SMIC. The original goal was to choke off China's access to advanced chip-making equipment. But that firewall has just been breached. The result? A feeding frenzy on both sides. China's about to go on a shopping spree for high-tech American components, while the US scrambles to hoard Chinese rare earths. It's a Cold War in full economic form, both sides buying time, stocking up for what comes next. But here's the key difference. China's weakness is temporary. America's is structural. Given enough time, Beijing can close the semiconductor gap. It has the engineers, the scale, and the resources to catch up.
But the US?
It can't rebuild rare earth refining overnight, not even in a decade. Right now, China controls over 90% of global refined rare earth magnet supply. The stuff that actually powers electric motors, drones, and defense systems. Mining is easy. Refining is the hard part, and that's where China dominates. So even if Trump spends hundreds of billions trying to rebuild that entire supply chain from scratch, it'll take years before America can stand on its own. Until then, Washington is stuck stockpiling Chinese materials just to keep industries alive. But here's the uncomfortable truth. China can shut that tap off whenever it wants. If Beijing decides to cut exports, the US burns through its reserves in months, not years. Especially with how massive the AI boom has become. Even Trump's advisors don't have a long-term fix. Scott Bessent, one of his economic strategists, still hasn't presented a clear plan beyond this 12-month window. So who really came out ahead? It doesn't look much like the art of the deal anymore. But that's just the beginning, because there's an even bigger storm brewing inside America itself. Let's talk about the Federal Reserve and what it's quietly doing behind the curtain. When you look closer, the so-called rate cuts are just another word for money printing. The Fed just lowered interest rates by 25 basis points, bringing them below 4%. That's a huge pivot, and not everyone saw it coming. Fed Chair Jerome Powell shocked the markets when he said December's rate cut isn't guaranteed. He might even pause until 2026. But make no mistake, this move didn't come from data. It came from pressure. Trump has been pushing hard for cheaper money, and Powell just blinked. Now here's where things get serious. The Fed's internal documents, the FOMC summary, reveal the pivot is officially underway. The printing machine is warming up again, and we can see why. Trump's ally inside the Fed, Christopher Waller, is openly pushing for deeper cuts, possibly 50 basis points next time. The Fed itself admits unemployment risks are rising fast. Layoffs are piling up. Amazon alone plans to cut 30,000 jobs. That's just the start. But the real shocker? The Fed's balance sheet. Starting December 1st, they'll stop shrinking it. In plain English, they're done selling bonds. For over a year, the Fed has been unloading up to $100 billion worth of U.S. treasuries and mortgage-backed securities every month to drain liquidity from the system, to fight inflation. That's ending. From December onward, no more tightening. That means more cash stays inside the system, and that's happening at the same time as interest rates fall. Why? To make borrowing cheaper, not just short-term but long-term too. The Fed is trying to engineer a soft landing, but this kind of move rarely ends softly. This combination, lower rates and a halted balance sheet runoff, is financial engineering at its finest. On paper, it looks like stabilization. In reality, it's the start of another wave of liquidity flooding the system. And that's dangerous. Since 2020, the Fed has already pumped nearly $3 trillion into the economy. That money is still sloshing around. If the next financial shock hits, whether it's a supply chain collapse, a credit crunch, or the AI bubble bursting, Powell will have no choice but to print even more. We've seen this movie before, in 2008, then again in 2020. Only this time, the scale could be historic. The Fed's pivot isn't just technical, it's a warning. The system is under strain. Trade wars, tariffs, inflation, layoffs, everything is pushing the US toward another round of emergency stimulus. So ask yourself, did America really win this round with China, or did Beijing quietly secure the upper hand? Because from rare earths to AI, from energy to money printing, the scoreboard doesn't lie. Let me know what you think in the comments below. Who's really ahead in this economic chess game? And do you believe the Fed's about to unleash another tidal wave of money printing? Stay safe, stay sharp, and keep watching, because what's coming next could reshape the global economy all over again.